Welcome to the Deep Dive, your shortcut to being well-informed.
Hello, everyone.
Today, we're plunging into the second quarter 2025 earnings call for Unisys Corporation.
That's right.
Our mission for this deep dive, well, it's to unravel not just the immediate numbers, but the bold strategic moves they're making.
Particularly around pension de-risking and AI.
Right.
Those seem like the big themes.
Exactly. We want to extract the critical financial insights, those strategic maneuvers, and really what it all means for you.
Okay, let's get into it. Because for Q2 2025, Unisys, they really delivered a strong beat on their headline financials.
Yeah, it gave the market quite a bit to chew on, balancing that performance with the longer-term strategy.
Definitely.
Okay, so let's unpack those headline figures first. On a non-GAAP basis.
Which, gives you a clearer picture of the core business performance.
Right, excluding those one-off items. Diluted EPS came in at a solid $0.19.
Yeah, that was a significant beat against the analyst consensus. Pretty strong.
And revenue also topped expectations. It reached $483.3 million.
Which is an 8.7% beat against consensus. And a healthy 1.1% increase year over year.
Or 1.0% if you look at constant currency.
Right, taking currency fluctuations out. And what's particularly striking is how that flowed through to profitability.
Tell us about the margins.
Well, their non-GAAP operating margin expanded by 150 basis points. That's 1.5 percentage points year over year.
Okay, up to 7.6%.
Exactly. And this drove adjusted EBITDA, that key measure of operational profitability, up to $61.4 million.
Representing what, about 12.7% of revenue?
12.7% margin there. Pretty healthy. However, there's always a however, isn't there?
The elephant in the room.
Yeah, free cash flow. It was notably negative, minus $336.5 million.
Wow. Okay, why so negative?
It was largely, almost entirely due to a substantial U.S. pension contribution they made.
Ah, the pension de-risking move we mentioned.
Exactly.
So with such a mixed bag, I mean, strong operations, but that massive cash outflow for pensions, how did the market really react? Was it clear thumbs up, or did that pension bit cause some, hesitation?
It definitely wasn't simple. You saw that immediate after-hours surge.
Yeah, typical for a headline beat.
Right. But then it settled down. It ended up as a modest gain the following day.
Okay, so what does that tell us? Cautious optimism.
I think that's fair. Cautiously bullish. Investors are weighing that strong operational delivery against the long-term but very immediate cash impact of the pension strategy.
It's that classic long-term versus short-term view.
Exactly. Looking past the immediate cash hit to the potential future benefits.
Okay, so let's dive deeper then. The specifics of that financial performance and the segment highlights.
Okay.
Unisys's Q2 revenue, that $483.3 million. It wasn't just the year-over-year increase, it also beat prior expectations and showed sequential improvement.
Yeah, and management specifically highlighted strength in license and support, L&S consumption.
Right. What does that L&S consumption really mean in terms of revenue quality for them? Is it just renewals?
It means clients aren't just, holding licenses. They're actively using them, renewing them, probably consuming more capacity. It's great for investors.
Because it's high margin.
Exactly. High margin, sticky revenue. It's predictable, less susceptible to economic swings. That's the good stuff.
Okay. So how did the different segments perform then?
Well, if we look at Enterprise Computing Solutions, ECS, revenue there grew a healthy 7.3% year over year in constant currency.
And the margin?
Really robust. Gross profit margin of 53.5%.
Wow.
Yeah. So the insight there is they're not just selling more, they're doing it incredibly profitably.
Yeah.
Fueled by that strong L&S consumption and integrated system purchases too.
Okay. And Digital Workplace Solutions, DWS, how did that look?
Also showed good momentum. Revenue improved 4.5% year over year.
And they mentioned stabilization in lower margin services.
Right. Lower margin field services stabilizing, but growth in the higher value stuff like enterprise storage and network services.
And that helped the margin in DWS.
It did. Gross profit margin there increased to 16.9%.
So what does that shift signify, moving from lower margin to higher value services?
It tells us they're executing that strategic pivot, moving up the value chain, which is what you want to see.
Right. Makes sense. But it raises a question, though, for their cloud applications and infrastructure segment, CA&I. That actually declined.
It did. Revenue down 4.5% year over year.
Why was that?
Primarily impacted by softness in the public sector. Seems related to client sentiment, maybe funding uncertainties, geopolitical concerns, that sort of thing.
Okay, but not all bad news there.
No, not entirely. The segment did see 2% sequential growth quarter over quarter. And management sounded, well, reasonably encouraged about the pipeline.
Especially in public sector and higher ed.
Yeah, suggesting maybe those pressures might be easing down the line. We'll have to see.
And tying back to overall profitability, that non-GAAP operating margin improvement to 7.6%.
Up 150 basis points year over year.
You said driven mainly by that favorable L&S mix and better operational efficiency.
That's the story. And adjusted EBITDA, as we noted, hit $61.4 million, or that 12.7% margin.
Okay. And just to really hammer home the free cash flow point again, that negative $336.5 million.
Right. Let's clarify that. It was, as we said, primarily due to that strategic $250 million U.S. pension contribution.
So it's like a big one-time payment.
Yeah.
An investment in fixing a future liability.
Exactly. Think of it like that. Management pointed out if you strip out that specific payment, their underlying operational cash generation.
The pre-pension FCF.
Yeah, that was a much less alarming negative $58.3 million. And adjusted FCF was negative $49.4 million.
So still negative, but way different.
Way different. That distinction is really crucial for understanding the core business health once you kind of mentally adjust for this big strategic cash outlay.
Right. Which I guess brings us neatly to perhaps the biggest strategic story of the quarter.
The capital structure and that pension de-risking.
Yeah, it seems like a key part of their transformation. They issued $700 million in senior secured notes due 2031. For our listeners, what's the core benefit of issuing new debt like this? Is it just cash?
Well, what's fascinating is how they use the cash from those notes. A big chunk, $485 million, was used specifically to refinance existing notes that were coming due in 2027.
So pushing out the maturity wall.
Exactly. It pushes their next major debt maturity out to 2031. That's a really crucial move for long-term financial stability. Buys them time, reduces near-term refinancing risk.
Makes sense. And that $250 million discretionary pension contribution we keep talking about.
Came from those new notes, mostly. $200 million from the notes, plus $50 million of their existing cash.
It does feel a bit like ripping off a financial Band-Aid, doesn't it?
Yeah. A bit painful maybe in the immediate cash flow, but potentially much healthier long-term, tackling that legacy liability head-on.
And they did more than just contribute cash, right? Something about asset allocation.
Absolutely. A really significant move. They shifted their U.S. pension plan's asset allocation largely into fixed income securities.
Okay, so moving out of, say, equities.
Primarily, yes. Think of it like swapping a potentially volatile stock portfolio for steady bonds. The goal is to match what they owe the liabilities with stable assets.
To immunize themselves from market swings.
Pretty much, making future pension contributions far more predictable. It reduces that future contribution volatility and, frankly, just simplifies the company's financial story for investors.
So what does this all mean for Unisys's long-term value proposition then? Fewer surprises.
That's the goal. Reduce future volatility, simplify the story, remove that historical overhang, and ultimately enhance long-term shareholder value.
And they might do more, something about annuities.
Yeah, they mentioned they're exploring annuity purchases. Could offload up to another $400 million in pension liabilities.
How does that work?
Essentially, they pay an insurance company to take over the responsibility for paying those pensions. Now, it could result in a non-cash settlement loss on the books, maybe up to $290 million.
A paper loss, though.
Right, non-cash. Yeah. But it would further streamline their liability profile. It's a very strategic, though sometimes optically challenging, set of moves designed to put the past firmly behind them.
Okay, so beyond the numbers and the balance sheet stuff, management also gave us a glimpse into their strategic playbook. What really stood out, I think, were the initiatives around embedding agentic and generative AI into their solutions.
Yeah, trying to drive both growth and efficiency there. It's a big theme everywhere. But how is Unisys specifically leveraging it?
Well, they gave examples. In digital workplace solutions, DWS, they have this thing called the Service Experience Accelerator, or SEA.
Right, using generative and agentic AI for like automated service desk functions.
Exactly. They said it increased end-to-end automation resolution from 15% up to 40%.
Wow, that's a significant jump.
Yeah. And the device subscription service, DSS, also combines AI with unique data sets.
So it's not just buzzwords for them. They see it as a real strategic advantage.
Seems like it. To scale delivery, enhance the client experience, lower costs. And crucially, they think it can shrink the size advantage that larger competitors have historically held.
Interesting. So the AI push is linked to that broader strategy. Freeing up focus by dealing with the pension allows them to invest more in this kind of future growth.
That looks like the plan. Now, what about the commercial pipeline? Backlog grew, right?
It did. Backlog grew to $2.92 billion, up 5% year over year. Solid.
But Q2 new business total contract value, TCV, was actually down 5% year over year.
Yeah, management addressed that. They attributed it to timing complexities in large contract negotiations, said it wasn't a fundamental demand issue.
How confident should we be in that timing issue explanation? Always sounds a bit convenient.
Well, you have to look at the context. First half new business TCV was actually up 15% year over year.
Okay, that's better.
Right. And they expect improved TCV in the second half. So it suggests Q2 might have just been lumpy, but the overall trend is still positive.
And more project work helps revenue recognition.
Yeah, project work made up a larger portion of new signings, and that tends to offer quicker revenue recognition than, say, long-managed services contracts. Helps convert that backlog into revenue faster.
Okay. And their alliance partner strategy sounds like that's paying off too.
Seems so. They talked about deeper engagement with a smaller set of partners, got 3 awards at Dell Tech World, including Dell's 2025 Global Alliance Growth Partner of the Year.
That's pretty good validation.
It is. And that DSS offering is also expanding into Apple devices now, which opens up new markets for them.
So what do these alliances signal, big picture?
Well, they're critical for extending their reach, validating their solutions. Shows Unisys isn't just building tech in a vacuum, but integrating it effectively into bigger ecosystems.
Gotcha. And they mentioned industry recognition too.
Yeah, appeared in 7 major industry reports, got new or improved rankings, and was named a global top 100 most loved workplaces by Newsweek.
That's interesting. Does that matter?
I think it does. Reflects a strong culture. And that's backed up by a low 11.7% trailing 12-month attrition rate. In this market, keeping your talent is vital for execution.
Good point. And quickly, in ECS, the Clear Path Forward strategy.
CPF 2050. The goal there is modernizing hybrid infrastructure, unlocking data, enhancing security encryption speed, keeping that core platform relevant.
Okay, let's shift to their revised guidance for the full fiscal year 2025. This was a key part of the call.
Definitely.
Unisys actually revised its constant currency revenue growth upwards to -1.0% to +1.0%.
Or reported managed 0.5% to +1.5%. Either way, it indicates an improved outlook from where they were before.
That's a positive signal, right? More confidence.
Absolutely. And maybe even more importantly, the non-GAAP operating margin guidance was significantly raised.
How much?
To 8.0%, 9.0%. That's up from a prior range of 6.5%, 8.5%.
Wow, that's a big jump. Why such a boost?
Driven largely by that higher L&S mix we talked about, and those improved operational efficiencies they're finding, shows real confidence in their profitability levers.
And the L&S revenue assumption itself was increased.
Yep, up to approximately $430 million for the full year. That's $20 million higher than previous estimates. Reflects that continued strength in client consumption and hardware.
And they gave a number for 2026, too.
Yeah, anticipated approximately $400 million for 2026. So still strong, maybe slightly lower than the peak 25 number.
Okay. What about cash flow guidance after that big Q2 outflow?
They expect approximately $110 million of pre-pension free cash flow for the full year.
Okay, so positive on an underlying basis.
Right. But they also anticipate another $55 million planned pension contributions in the second half of 2025. So those strategic payments continue, just smaller.
Got it. What about the near-term Q3 outlook?
For Q3 management projects, about $390 million of ex-L&S revenue, so everything but L&S.
Okay.
And $95 million of L&S revenue. They expect year-over-year reported revenue decline in the low single digits.
Okay, so a bit softer sequentially on the top line.
It's like it. And non-GAAP operating margin in the mid-single digits. They put that down to timing. But here's the kicker for the rest of the year.
The Q4 inflection.
Exactly. A strong positive inflection in Q4 growth is anticipated, backed by significant increase in L&S revenue and profit, converting that ex-L&S backlog, higher field services volumes, and upfront components from deals signed in the second half.
So a back-end loaded year, especially for margin and growth.
Very much so. Q4 looks pivotal.
Okay. So when we connect this to the near-term catalysts, what should listeners be watching? Successful execution against that ambitious 8%, 9% operating margin target for the full year is obviously key.
Absolutely number one. Can they deliver that?
What else?
We'll also be watching the cadence of L&S renewals. Do they hit that updated $430 million full-year guidance?
Right, and the pension stuff.
Yeah, the finalization of any of those annuity transactions to offload more pension liabilities. And the associated accounting implications, remembering that non-cash loss potential.
We also need signs of stabilization in the public sector, right, for the CA&I segment.
Definitely. Increased demand, there would be a positive signal. And, continued positive analyst coverage helps sentiment, like Needham's recent buy rating and $6 price
Yeah,
target.
and any upside surprises.
Yeah, any upside in that XLNS performance, or if they land some unexpectedly large TCV deals, that could further re-rate the equity.
Okay. So stepping back, looking at the broader investor context, that substantial pension de-risking strategy, it hit Q2 cash flow hard, but it's clearly a critical long-term play.
Absolutely. Aiming to stabilize cash flows, remove that historical volatility, make Unisys more appealing to investors who value predictability.
It's been a long-standing issue for them.
It really has. And related to that, the strong focus on integrating AI, especially in DWS.
Right, the agentic and generative AI.
That positions them for better delivery efficiency, a stronger competitive stance against the bigger players. It's kind of their way to level the playing field using tech.
And while the overall IT services sector faces mixed demand, particularly public sector,
Management is framing that TCV softness as a timing issue, not fundamental demand collapse. They point to the robust pipeline as indicating future growth.
we'll see if that holds true. But the raised margin outlook, plus the capital structure improvements, it does suggest an improving profitability trajectory.
Yeah, and recent analyst coverage seems to reflect that cautiously bullish sentiment towards these strategic shifts and their internal execution.
Okay. All right, let's pivot a little. For our experienced investors listening, let's consider a speculative but maybe intriguing angle on Unisys.
Okay, the not financial advice segment.
Exactly. Disclaimer firmly in place. Given the aggressive pension de-risking and that clear focus on margin expansion through AI and high-margin L&S, here's a thought.
Go on.
Imagine a scenario where Unisys really does aggressively pursue those annuity purchases, offloads that remaining $400 million in liabilities.
Okay, which triggers that potentially large non-cash settlement loss, maybe up to $290 million.
Yeah.
That headline number might spook some people initially.
Right, it might. But what if the market actually looks past that non-cash charge and front-runs the long-term benefit? The predictability, the simplified balance sheet this creates.
So the trade idea.
My clean balance sheet and AI growth arbitrage idea, maybe go long Unisys stock, but simultaneously buy some out-of-the-money call options, perhaps expiring 6-9 months out.
Okay, so long stock, long calls. Why the calls?
It targets an upside if the market re-rates the stock, not just on hitting that 8-9% margin for FY25, but on the perceived clean slate and the faster AI-driven growth that the pension clarity enables.
So it's not just about this quarter or the next. It's a bet that the market finally gives Unisys credit for de-risking its past so it can fund its future.
Exactly. The optionality in the calls is there to capture that potential re-rating if those annuity transactions go smoothly and management keeps delivering on the AI-led efficiency gains.
And if that non-cash settlement loss does initially cause a dip in the stock price.
That could actually be the buying opportunity for the stock leg, anticipating the broader market, eventually appreciating a leaner, more predictable Unisys, finally unfettered by that legacy pension volatility.
Interesting. So it's kind of a buy the rumor, sell the news on the pension cleanup, but with a twist.
The twist being you're betting that the news of the cleanup actually unleashes the growth story, especially in those high-margin L&S and AI-augmented services.
A speculative angle for sure, but grounded in the strategic moves they're making.
Definitely speculative, not advice. Okay, let's recap our deep dive. Unisys delivered a strong Q2, beat revenue and EPS estimates.
And significantly raised its full-year operating margin guidance. That was a key takeaway.
The company has taken these bold, decisive steps to de-risk its U.S. pension liabilities and strengthen its capital structure.
Setting a foundation they hope for more predictable future cash flows.
Now, free cash flow was negative because of that large strategic pension contribution.
But management frames that as an investment for long-term financial stability, paying now for predictability later.
Meanwhile, Unisys continues to integrate AI into its solutions and is seeing strong performance in its high-margin L&S business.
Right. The path ahead really involves executing on that raised margin target, watching the L&S renewals closely.
And observing the impact of the ongoing pension de-risking and whether public sector demand truly stabilizes or picks up.
As always, this discussion is just for informational purposes. It doesn't constitute financial advice.
Absolutely. We encourage all listeners to conduct their own due diligence. So the big question remains, will these bold strategic moves finally allow Unisys to shed its legacy baggage and fully capitalize on these new growth engines, particularly AI?
That's certainly what investors will be watching in the coming quarters.
We appreciate you joining us on the deep dive.
We look forward to your input and engagement. Until next time.